A simple product does not always equate to a simple industry, and the cement industry is a prime example. While it is hard to list a product simpler than cement, the Indian cement industry is ripe with intricacies. Today, two corporate giants, the Birla Group and the Adani Group, are at the heart of recent cement industry shifts. So how did it all start? By the early 2010s, India had become the world's second largest cement producer. But the supply side was highly fragmented, especially in the south and the east. Overcapacity was eroding pricing powers and margins, while large players were seeking growth beyond their home turf. Big names like UltraTech and Ambuja started picking off regional players to shore up scale, sharpen their bargaining power on limestone and fuel, and crack open fast-growing markets beyond their home turf. By 2014, the acquisition frenzy was in full swing. UltraTech snapped up JP's grinding units in Rajasthan and Madhya Pradesh, Ambuja added ACC stakes, and Shree Cement bagged JP Cement. Over the decade that followed, around 18 major transactions shifted nearly 195 million ton of capacity, lifting the top 5 players to control more than half of the country's mills. Then came mid-2022 when Adani crashed the party. Holcim, a Swiss construction company, set its India arm on sale in April when Adani Group had agreed to spend about $10.5 billion for a controlling stake in Ambuja and ACC, India's largest infra-material takeover ever. Overnight, Adani shot straight to number 2 behind UltraTech with a capacity of now 100 metric tons. This led to the Adani versus Birla race. UltraTech and Adani's combined capacity could exceed 300 metric ton per annum in a few years. That's nearly half the nation's current capacity. What this really means is that India's cement landscape has morphed into an oligopoly built on inorganic growth. Moving forward, how will the Big Five, with their 54% production capacity share, write the next chapter in India's infrastructure boom? Let's find out. Welcome to Bottom Line by Groww. I'm Radhika Bajaj. In today's episode, we're breaking down the Indian cement industry, its structure, business model, and the key challenges and demand drivers lying ahead. Before we dive into the industry, let's try and understand how cement is actually made. Cement production begins with the extraction of limestone, plus a bit of clay and small amounts of iron ore to form the basic raw mix. Once quarried, these rocks are crushed into a coarse powder, then carefully blended in silos. This is fed into a rotary kiln, where it's heated to create nodules called clinker. On its own, clinker sets too quickly and is grainy. So, it's milled again with gypsum, slag, and pozzolanic materials. The result is a fine powder, your cement. Once milled, the finished cement goes into moisture-proof silos, ready either for bagging in 50-kilo sacks or for bulk shipment. To make concrete, the cement is simply mixed with sand, gravel, and water. Looks like it's quite a simple process, isn't it? Actually, it's not that straightforward. If someone gave you cement produced by 2 different brands and asked which is which, would you be able to tell the difference? No, right? Cement is a true commodity. Brands may plaster their logo on every bag, but the product inside is virtually identical. So there's little customer loyalty beyond basic quality assurances. Yet, major players still pour money into advertising to stay top of mind. In the end, market share comes down to who can deliver reliable cement at the most competitive price. Thereby, cement is a cutthroat cost game. To understand this further, let's dive into the cost economics of the cement industry. First, the raw materials. Raw materials account for about 20% of cement cost, mainly limestone concentrated in Western India. Rajasthan accounts for about 23%, and then there are the southern states. Its bulky nature drives plants near quarries, so the south leads capacity with Madhya Pradesh having the most plants. Large players have their own quarries to ensure regular supply. Over 80% of gypsum is actually sourced from Rajasthan, along with fly ash and steel-making slag. And these are key inputs. But slag availability in India is limited to the eastern steel belt. Secondly, there's power and fuel. Power and fuel make up 30 to 32% of costs and rely on both domestic and imported coal, petcoke and lignite. Major players run captive thermal, wind and solar plants and also own coal mines. But most industry coal still comes from eastern India. Thirdly, there are freight costs. Freight accounts for 26% of cost and is high due to cement's bulky and perishable 90-day shelf life. Geographic mismatches between quarries, fuel sources and markets elevate haul costs significantly. Firms counter this by deploying split location units close to raw material sources and end-user markets. Now clearly, cement is a cutthroat cost game, as we have told you, and as such, the need is for cost optimization through economies of scale and efficiency improvements. This is where consolidation helps. Mergers and acquisitions allow larger companies to achieve economies of scale in production, procurement, and distribution. By integrating smaller players, they can streamline operations and enhance overall efficiency, which translates to higher profitability, especially in a challenging market environment with fluctuating input costs. This is why the past 2 to 3 years have seen 116 empty capacity exchange hands via M&As. Having viewed the wave of mergers and acquisitions, let's now examine the underlying structure of the cement industry. As of FY24, India had 341 manufacturing units, 159 integrated plants, 120 standalone grinding units, and 62 mini cement plants. Together, they're offering about 639 MTPA of installed capacity. The Indian cement industry today splits into a dominant organized segment with 61% market share and unorganized with the remaining 39% market share. Unorganized producers lack captive quarries and power, rely on third-party clinker, and face higher fuel, logistics, quality, and financing costs. Factors that have shrunk their share as organized majors expand organically and via mergers and acquisitions. Whereas in the organized segment, the top 5 players now control about 54% of national grinding capacity, up from 39% in FY14. As of FY24, UltraTech leads at 140.8 MTPA, followed by Ambuja's at 78.9 MTPA and Shree Cement's 53.4 MTPA. Within the top 5 players, the Adani Group's cement flagship now brings together Ambuja Cements Limited and ACC Limited. Through direct and indirect holdings, 54% of ACC and 63% of Ambuja, plus Ambuja's 72.66% stake in Orient Cement, the group commands roughly 100 MTPA of capacity today, with a 140 MTPA target by 2028 via ongoing expansions. Adani's real advantage lies in its vertically integrated infrastructure, port handling and coastal shipping through Adani ports, freight transport on dedicated rail corridors, and low-cost captive power from Adani Power, backed by its own coal assets under Adani Enterprises. In FY25, Adani picked up smaller assets as well. Acquisitions like Penna Cement and Shagi Industries. Moreover, Ambuja Cements has best-in-class cost controls, long-term raw material contracts, and much higher fly ash blending cut its input ratio to 16.9%. Freight and fuel optimization via its master supply agreements or MSAs, waste heat expansion and captive coal sourcing all slash logistics and energy bills, turbocharging its EBITDA margins to 25.6%. On the other hand, UltraTech Cement, the flagship of the Aditya Birla Group, remains India's largest cement producer, with domestic cement capacity rising from 140.8 MTPA in FY24 to 183.4 MTPA in FY25. Behind this year-on-year 42.6 MTPA jump lies a bold acquisition strategy. In February 2025, UltraTech completed its 7,600 crore rupee purchase of Kesoram Cement. In June 24, it invested $228 million to secure a 23% stake in India Cements, and it has also acquired about an 8.7% stake in Star Cement. It has been investing heavily in waste heat recovery system and renewables as green power mix jumped to 35.7% in Q4 FY25 to drive down power costs. But the scale-up lag means its fuel ratio, 24.3%, remains above the average. Now, the company is targeting roughly 210.5 MTPA capacity by the end of FY27. Thus, in the last 3 years, both Adani and Birla have clinched several southern deals, indicating a turf war in growth region. Beyond the two giants, several organized players add to India's cement market. Dalmia Bharat, a pure-play cement maker with 15 plants and 49.5 MTPA of capacity. Growth comes from brownfield and selective greenfield sites with a clear roadmap to reach between 110 to 130 MTPA by 2031. Then there is Shree Cement with roughly 56.4 MTPA of cement capacity. It has built its strength in North and East India through brownfield expansions and a steady push into premium products that lift realizations. Its polymer packaging business further diversifies revenue streams as well. Moreover, it has industry-leading energy economics with over 60% green power mix and 582 megawatt captive solar means its input ratio plunged to just 10.1%, the best among peers. JK Cement combines about 24.3 MTPA of grey cement capacity and 3.0 MTPA of white cement across 16 integrated plants and 14 grinding units. A pioneer in white cement, it has built a strong value-added ecosystem under the JK Max banner and is backing that up with both greenfield and brownfield growth to hit 50 MTPA by 2030. But how has the overall industry performed in the past decade? Over the past decade, India's leading cement producers have delivered modest top-line growth. Aggregate sales CAGRs for most big players like UltraTech, Ambuja, JK and Shree cluster between 12 to 13%, while ACC has trailed at roughly 6%. Profit growth has been even more uneven, especially in the last 5 years due to margin pressures. Even Shree Cement, which posted a robust 20% profit 10-year CAGR, saw that surge tempered by intermittent spikes in raw material and logistics costs. This came as a result of cost push. Imported petcoke, which is an alternative to coal in modern kilns, more than doubled in cost in FY22 and remained elevated in FY23. Domestic petcoke mirrored this as well. Meanwhile, Coal India linkage prices were hiked by 8% in May 23 and diesel also surged, keeping overall thermal fuel outlays far above historical norms. Secondly, the cement industry's close ties to economic and real estate cycles means that volumes can plunge sharply in downturns, and the limited pricing power, with average retail prices rising just 1% CAGR over the past decade, leaves producers unable to pass on rising input costs, exposing profitability to economic swings. But why are they all still standing? Because cement is not a luxury, it's a must-have. Even when volumes slow, replacement cost economics are daunting. Building a modern 5 MTPA plant costs about 4,000 to 5,000 crore rupees, so competitors can't easily undercut by adding new capacity. Big players leaning on captive quarries, in-house power plants and their own shipping fleets to protect margins. And with consolidation, price discipline, which was once elusive, could slowly creep back. Moreover, significant reserves also enable them to fund capacity expansions, invest in technology, and weather cyclical downturns. That's why, despite these operational headwinds, cement stocks have outperformed their business fundamentals, with 10-year share price CAGRs of 15% for UltraTech and a standout 26% for Shree Cement. Most of this outperformance reflects multiple expansion rather than quantum leap in earnings. This brings us to another key question regarding its valuation, as most of them appear to be trading above the historical medians. This re-rating reflects more than just current earnings. It's driven by improved balance sheet health, steady mid-teens ROEs, consolidation among the largest players, and the promise of a long-cycle infrastructure build-out. But it also means valuations have outpaced the underlying business momentum. Moreover, key government initiatives underpin this optimism for the cement industry as well. Over the past decade, rural housing has emerged as a major cement demand driver. powered by the Pradhan Mantri Awas Yojana Grameen scheme. Since its 2016 inception, this scheme has sanctioned roughly 3.79 crore homes and completed about 2.72 million by March 2025. With nearly 70% below urban levels, the segment has significant headroom as mud and thatched homes convert to concrete structures. Moreover, as India's urbanization rate climbs towards 40% by 2030, urban cement demand expanded 8 to 9% in FY24 and is projected to moderate between 5.6 and 6.5% in FY25, reflecting both rising incomes and ongoing affordability pressures. Adding on, the infrastructure sector has swelled its share of total cement consumption from roughly 11 to 13% to 29 and 31% in FY24, driven by record public capital outlays. Subsequently, the union budget for FY26 allocated a staggering 11.21 lakh crore rupees for capex across roads, rail, metro and port projects. As such, infrastructure segment cement volumes are forecast to grow as flagship programs like PM Gati Shakti and the National Infrastructure Pipeline enter higher execution phases. Structurally, India's per capita cement usage remains at just 280 to 330 kilos, which is barely 55 to 70% of the global average and a fraction of China's 1400 to 1500 kilos, signaling a large catch-up opportunity as household formation and incomes rise. With booming infrastructure spend, rural demand revival, and green energy efficiencies, while valuations remain at multi-year highs, can India's cement industry ramp per capita consumption up to the global average and spark a truly transformational shift? What do you think? Let us know your thoughts in the comments below.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.
Since its 2016 inception, this scheme has sanctioned roughly 3.79 crore homes and completed about 2.72 million by March 2025.